Hi there, I'm Matt Epstein with Berkshire Hathaway Home Services. I'm here with John Musso today from Wells Fargo. I've known John for years and years. In my mind, he's the top home lender at Wells Fargo, but I think you're nationwide. But are you number one, number two?
Statistically, I'm number two nationwide in the company.
Losing it, dude.
Sorry.
Losing it. All right, well, good. We're here to talk about interest rates. Interest rates. You know, we've heard the talk. Interest rates are going up. It's going to affect the housing market. Talk to me. How quickly should people get on board and buy a house to lock in these great interest rates?
Well, I'll tell you. It's interesting because we've got to step back a little bit. The Federal Reserve has talked about raising rates for quite some time, and they kept throwing it out. We got to raise. We're going to raise the rates. We're waiting for the economy to get footing, and they just every time they got to that spot, the economy slowed down a little bit, and they couldn't actually raise the rate. So when December came of 2015, they had gotten to the point where they had to actually do something. They had to say they were going to raise rates, and they had to follow through. And they did. But the net effect was complete status quo. We didn't really see any change to what we're doing, to the mortgage market, to the selling market, the buying market, real estate. Everything has pretty much stayed the same. Interest rates are still low. They're remaining low, and the rate that they changed was the lending rate between the banks. So there may have been some changes, slight changes that went on with the banks, but nothing that's really getting passed on to the consumer, and nothing that's being felt right now.
Okay, so when the Fed said that they raised their interest rates 0.25%.
Correct.
They're talking about doing additional 0.25% interest rates in this year, 2016. I'm kind of not shocked, but because I've been in this market a long time. For 2016, do you think interest rates are going to, as far as home purchases, are going to be remain low? I
do. I think that the Fed will try. They're talking about 4 additional rate increases for 2016. I don't believe that's going to happen. Today, the Federal Reserve came out and they didn't announce, but in their minutes of their meetings stated that if they do any more increases, they're going to be gradual. So if you look at the word gradual, it really means that they're not set to do it in a month, in 3 months. It could be 6 months to 8 months. They may do another one. They're going to try to feel the economy out and just see if the economy can handle any of these rate increases. And what they're really trying to do is just keep inflation intact. And by raising these rates, they can keep up with the rate of potential inflation. The economy is doing well. People are buying houses. Things are moving, but not to the level where interest rates can suddenly jump up overnight.
Okay. So as far as affecting the selling market, I would think that because of the folks that aren't like you that really know how it's going to be affected, and the overall assumption that interest rates are going up, it might affect the selling market by making it more active right now, or not. What are you seeing in the marketplace as far as?
I do see a lot of that happening. I've talked to sellers who want to get their houses on the market, and they want to get some action on their houses, thinking that rates are low now, and if the affordability factor is there, and their house is going to sell a lot faster now. But I think that that's going to stay for a while. I really think that we're gonna be playing this tune for at least another year or two, and I think the market's going to be good. I think the values are going to be good, and I just think the combination is going to be great to keep this market moving the way it should be moving.
Okay. So year or two, be a future teller. Talk to me about 3 years, 5 years. What's going to happen?
Well, I'm going to go back to the gradual word that the Fed used. So if gradually they raise rates, slowly our economy is going to absorb the higher rate and not feel it. So if today we are at 3.875 and 6 months from now we went up to 5%, that would be a big change.
That'd be huge.
It'd be huge.
Yeah.
And that would cause a lot of disruption.
Right.
But if it's a gradual change and inflation kicks in a little bit as time goes on. People's salaries go up a little bit. Interest rates gradually go up. Home values continue to go up gradually. If everything stays in a gradual mode, I don't think there's going to be any type of panic that's going to go on the next, 2, 3, 5 years.
Okay. All right. But even it's so funny to say, 5% that it's going to be a huge effect on the market. I mean, it's laughable. I mean, I bought my first house in the early '80s, and I had my first interest. The interest on the first mortgage was 12.5% interest, and we were so excited. I remember the industry wide. It was so excited to see it under 10%.
Exactly.
And I mean, we were in inflationary periods at that point, but panicking if we get up to 5% is so laughable. I mean, it's interesting. So there's new programs out with the Fed, right? There was a program that they had that was intact for the last 10 years. Is that correct? And that's changed? No.
There's no new program, but there is new regulations and new ways that that we actually have to put loans together, get them on the system, and it has to do with disclosure and being very open with the consumer so they understand what they're getting into when they're purchasing a home and what fees are going into it. There was a time in the past, prior to 2008, that people were going into escrow and not understanding what the costs were going to be, what their rate was going to be, and they were getting to the signing table and the rate was higher than what they were told it was going to be. The fees were higher, they didn't have enough cash, and there was a lot of stress going on at the closing table. And when 2008 came and we had the meltdown of the mortgages, the government said they were going to...
This was the Dodd-Frank reform.
Yeah, they were going to do a reform to our industry, and they did.
Okay.
And those changes came out, and one of the big changes was what they call TRID.
Okay.
And TRID is just a disclosing to the client...
A truth and disclosing.
Yeah, truth and disclosing to the client in a way that is easy for them to understand. And so now all lenders have the same exact disclosure format. So if you go to B of A, you go to Chase, you go to Wells Fargo, you're going to see the same form in the same format with everybody. And it's easier for the consumer. But the flip side is it's a little bit more time consuming on the front end for everybody, meaning there could be delays involved with being able to do part of the process if that process is not fulfilled in a way that is efficient to the system.
Okay.
Now that's complicated, but
it's complicated, but it's dumbed down to the sense that the buyer, Joe average buyer that doesn't have the experience that you or I have, is going to go to the closing table and get what they thought they were getting.
They're going to get what they thought they were going to get. Correct.
So it's actually a government reform that should be good for the consumer.
Correct.
Okay.
But what people are hearing is, there's going to be delays. There are potential delays. So you have to understand that.
Right.
Wells Fargo has a system called Loan Tracker. We eliminate those delays.
Right.
So we're not actually experiencing those delays, but there are lenders and people out there that don't have the systems in place that are experiencing the delays. And that may be the negativity that some people are hearing about the trip.
There's also delays with not experienced agents coming in.
Correct.
Getting credits last minute, doing new stuff last minute. That again, there was some of the shenanigans, and again, some. I think overall that the TRID is a good thing for the consumer. The reform, I think it could have actually gone even stronger, but it should be good. Now, are you still able to close loans in 30 days, or is that?
We can.
Okay.
Yes.
Okay.
We can.
When TRID started, I think that was back in October, right?
Correct.
Okay.
Yes.
Right. And we were quoting our clients usually basically 45 days to close a deal, and that was to give the lenders a little bit of time for the new paperwork.
Correct.
Is that off the tables now? 30 days is the normal, or still 45 days recommended on a regular?
For us, 30 days is the normal.
Okay.
So we can do that.
Okay.
There are lenders out there that are going to need 45 days.
Okay.
Mortgage brokers, for instance, they will need a longer period of time. Direct lenders, banks will be able to do it in 30 days.
Got it. Okay. Anything else you want to add about the market and the world?
I think that there is a little bit of unsettling going on in the world. And when that happens, it's actually not a bad thing for us and with interest rates, because as things get unsettled, people want to put their money in safe avenues, and the treasury market is where people will put their money for safety, and so that helps interest rates. So I just think with everything going on, it's going to really keep our industry and our business stable and level, and I don't see a lot of change, and once again, any changes I think will be gradual.
Okay. And just one other thing, the refinance market, talk a little bit about that. How does TRID affect that? How did these new interest rates affect that?
There's honestly really no effect to the refinance market, because on a refinance, there are no timelines like there are in a purchase.
Okay.
Right. You don't have to order an appraisal by a certain date. You don't have to have your loan approved by a certain date. So on the refinance side, it's really business as usual. As far as rates go, if somebody has a rate that is 4 1/8 or 4 1/4, they should be refinancing. If your rate is in the threes somewhere, you've probably taken advantage of where the rates are.
Okay. So just this is January 2016. Jumbo, again, dumb it down. Give a basic, what are the rates at right now? What are the jumbo rates looking at? What is a jumbo loan?
A jumbo loan is considered anything over $417,000.
Okay.
So under $417,000 is considered a Fannie Mae or Freddie Mac.
It's called a conforming loan.
Conforming loan.
Okay.
And all those loans get sold to Fannie Mae or Freddie Mac. Anything over that is considered jumbo. Now, what's interesting...
So
okay.
On the conforming loans, somebody's putting 20% down. What are they looking like? 30-year fixed rate with Wells Fargo right now?
They're probably around 4%.
Okay. And a jumbo loan, what kind of rates?
If they're looking at a jumbo loan, they're probably going to be more like 3.625.
So jumbos are less money for more money.
Correct.
Okay. And what about the super jumbos? The super jumbos start at $1 million and over?
You know what? Those jumbo rates go all the way up to $10 million.
Okay.
Okay. So a 417.5 loan versus a $10 million loan will have the same rate.
Wow. Okay.
Yeah.
And what about short term, 5-year, 7-year money?
Any of those type of, the 5-year and the 7-year are under 3%.
Okay.
And then as soon as you go 10-year, you're probably looking around 3 3/8, 3.5. So it's the 10-year is really in between the shorter term arms and the fixed rate.
Okay. And you guys have a great loan I've actually put a couple of clients into, and they absolutely love it. And I think you guys are the only ones that are doing it where
It's called a recast loan.
Recast loan. Don't touch me there.
Sorry.
That's okay. Recast loan. So you take out a loan and you get a bonus, and instead of paying your loan down, your mortgage payment stays exactly the same with all the other loans. I had that problem a handful of years ago. I paid off a big chunk, and I thought they told me that the rate was going to go down, and it didn't. And then I refinanced it with you guys, and we took care of that problem. Give us a dumbed down version of this. What do you call it? Recast loan?
It's called a recast.
Okay.
And I will tell you, it is, I think, the best thing that has ever happened in the mortgage industry. Okay. And what happens is people, they do a 30-year fixed, and they lock into a 3.625 rate, and they have this payment, and let's say their payment is $5,000 a month.
Right.
Okay. And as time goes on, they make commissions, or they get bonuses, or they have some
inheritance, something happens, right.
They sell a property,
right.
and they get some extra cash, and they want to pay their loan down, and they want to lower their payment. And it will never lower your payment. What it'll do is shorten the term on the loan.
Right.
So what this recast feature does is it allows you to lower the balance and then lower the payment. So what happens is the term is still staying the same. You're not extending your term. It's staying at what you signed up for. It's just you're able to lower your payment. So people can go from a $5,000 mortgage down to a $3,000 mortgage.
But it keeps the term of the loan stays the same and the interest rate stays the same.
Everything stays the same.
I love that. And again, a few of my clients have gotten into that, and it's been fantastic. And I think that's, Do you think that's going to be a trend of the industry, or you think because the banks don't really like that in the sense that the refinance, there's really no reason for somebody to refinance. Well, I guess there is, but if
Well, I had a lot of people that were refinancing and spending, cost to refinance
Right.
just to lower their payment.
Right.
So you're correct. It's like a modification that we're doing to the note, and I think there might be a little extra work involved on the servicing side, on the lender side, but I think it's such a great feature, and we haven't seen anybody else doing it. So right now,
Okay.
we're the only ones doing it.
all right, one last question. You see the movie The Big Short?
I did.
What'd you think of that?
I loved it, and I thought it was exactly as it happened.
Yeah. You and I lived through that.
We lived right through
and
it.
it was. I know it's
Exactly.
pretty crazy.
Yeah.
The narrative, the narrative with the little cameo parts was brilliant. I thought it was an interesting movie.
What was so interesting?
What are you
is-
touching
Sorry.
me?
What was so interesting? I'm Italian.
I know.
Is that
You related to this guy?
no?
Okay.
But what's so interesting is that the subprime market was falling apart, but the Wall Street was not letting anybody know that
Yeah,
that was happening,
yeah, yeah.
and they were packaging the good loans with the bad loans,
Yeah.
and nobody knew.
Yeah.
And it's crazy.
Yeah,
It's exactly what was going
It
on.
was interesting.
Yep.
Thank you for joining us. I'm Matt Epstein. If you have any questions about real estate, I can be reached at 818-789-7408. You can see this entire interview and our article on our website, mattepstein.com. John, you want to give your information as far as how to, if you want
John.
to, sorry, if you want.
That's okay. John Musso, Wells Fargo, 818-518-1008.
You have a website or an email?
My email address is john.musso, M-U-S-S-O, at wellsfargo.com. So john.musso@wellsfargo.com.
I like the way you said that twice. I only said mine once.
No,
All right, thanks, John.
mine's more complicated.
All right.